Good afternoon, everyone. Welcome to the iSectors third quarter 2022 market review. We'll give it just a couple seconds here for anyone else who may be joining the room. Okay, we will get started. So again, like I said earlier, this is the iSectors third quarter 2022 market review. I am your host, John Cook, Senior Investment Analyst at iSectors, and I'm going to be joined today by our CEO, Vern Sumnicht. He's going to be giving, at the end of the presentation, an economic update and an example of a good way to blend the iSectors models for this economic environment. Before that, though, I'm going to briefly really do a kind of quick hit on a few of our models, quarterly performance in the third quarter, and I'm also going to touch on some of the model changes we've made in the third quarter here as well. And at the end, I should also mention, at the end, there's going to be a question and answer segment. So if you have any questions throughout the presentation, just type them in the bottom right-hand corner. There's a chat box. You can enter those questions in, and we'll hit on them at the end. You can enter those questions at any time throughout the presentation. So with that said, let's get started. Okay, like I mentioned, I'm just going to do a quick performance overview here of a couple of our notable models. If you want a full performance presentation, you can go on our website or reach out to us at any time. I'm just going to hit on a couple things here quickly so I don't take too much of your time this afternoon. First though, I'll hit on our fixed income model, starting with capital preservation, our iSectors domestic fixed income allocation, and the iSectors global fixed income allocation. All of these models outperformed their benchmarks, both in the third quarter and have so far year to date as well. The capital preservation is benchmarked against the Bloomberg 1 to 3 year government credit index. The domestic fixed income is benchmarked against the Bloomberg aggregate bond index, and global fixed income is benchmarked against the FTSE World Government Bond Index. You can see the notable outperformance here for all three models, mainly due to the lower duration profiles they all have compared to their benchmarks. Next, I'll hit on our domestic equity model, which I'll go real quick here because we're going to be touching on this later in the presentation as well. In the third quarter, it underperformed its S&P 500 benchmark, but has been outperforming pretty consistently year to date, the S&P 500 by about over 4% thus far. And that outperformance is mainly due to its quality dividend ETF exposure, which again, like I said, I'll mention later as well. Another model we should point out is our inflation protection allocation, the iSectors inflation protection allocation. You'll see, comparing it to its benchmark here, it's benchmarked against the CPI. So it looks like quite a bit of underperformance versus the CPI, but it's one of our best performing models just on a absolute return basis this year. And actually, it's our most successful model in terms of inflows year to date. So it's not only having a decent year performance-wise, we're also seeing a lot of advisors open accounts in this model and kind of using it as a satellite allocation to complement their traditional equity and fixed income exposure. And again, we'll hit on this model later as well. Vern's gonna bring it up in that blend we talked about. Another model to point out is the iSectors tactical global balanced allocation. This model is benchmarked against a 60/40 stock bond index, and actually on a relative basis compared to its benchmark is the best performing iSectors models so far this year. And that's mainly due to the fact that it can invest certain portions of the model in cash, and it has throughout this year. In fact, it's the only iSectors model that has the ability to go to 100% cash, or short-term bonds really is what we use as a cash substitute in this model. And that's been the main driver of its outperformance this year, as you can see, outperforming its index by almost 16%, 60/40. And actually, currently, it is 100% invested in short-term high-quality bonds. And again, this model we're going to hit on later as well. Just wanted to point that out. And I'm going to point out our flagship strategies, the iSectors PostMBT Growth allocations. They have both outperformed their benchmarks so far this year. PostMBT Growth compared to the S&P 500 index, and moderate is same benchmark as tactical global balanced, the 60/40 stock bond blended benchmark, as you can see here. And actually, so we're gonna take a little bit deeper dive on these models on the next few slides here, and talk about some of the recent allocations they've made, as these are models that we re-optimize every month. We run our proprietary algorithm, and it spits out a new allocation every month for us. So starting with PostMBT Growth, right now, the algorithm behind this model is pointing towards a stagflationary economic environment, and the model represents that. It has high energy and gold allocations as its inflation hedge. And it also has a max allocation in healthcare, and also a moderate allocation here into utilities. So the allocation right now is split between inflation hedges and sort of defensive equity positions. Um, you know, basically signaling that stagflationary environment that I mentioned before. Moving on to moderate now. Moderate, it really mirrors growth pretty well, but just as with a lower risk target. So it's essentially the same thing, just a lower risk stagflationary allocation. It has, high maximum energy allocation, a little bit less to gold, but still about 33% total in inflation hedges. It also has a 30% max allocation to healthcare as a defensive equity position. However, this model does include some treasury bond exposure at about 34% instead of utilities that growth has. Just again, so having those bonds is more of a recession hedge, and it just kind of speaks to the lower risk profile of the moderate allocation versus growth. Okay, next I'm going to hit on the iSectors crypto block allocation, mainly because we made a fairly sizable change in this model in the last month, this is more of a strategic model usually, so we don't often change it. But this last quarter, we sold the Grayscale Bitcoin Trust as the Bitcoin, kind of the pure Bitcoin exposure of the model. So this model is about 50% allocated to pure Bitcoin, or as pure as you can get anyway, without truly owning Bitcoin. The Grayscale Bitcoin Trust was a spot Bitcoin investment trust. And then the other 50% of the model is allocated to blockchain equity ETF. So sort of a 50-50 allocation between pure Bitcoin and blockchain equities. So we had been using the Grayscale Bitcoin Trust as the pure Bitcoin allocation. But this last quarter, we actually sold out of Grayscale completely. And we bought the ProShares Bitcoin Strategy ETF, which is, as you may know, it's a futures-based Bitcoin ETF, which is meant to track the price of Bitcoin without actually owning any Bitcoin itself. The Grayscale fund does own Bitcoin, but BITO does not. As you can see in the chart on the right, their returns have tracked pretty well over the last year, which was BITO's inception was about a year ago. And at first, we didn't buy into BITO just because we wanted to see and kind of check and make sure it would track the price of Bitcoin like it said it would. And after tracking it now for almost a year, we're confident that it does track the price of Bitcoin. And as you can see, its returns are pretty in line with Grayscale itself, obviously a little better over the last year. And one of the reasons for that is that BITO being a pure ETF, has a lower fee structure than the Grayscale investment trust does. So that, coupled with the recent performance, kind of led us to make the swap from Grayscale to BITO this last quarter. Just touching on this allocation again, in general, it's available on the Orion, Folio, FN, and Adhesion Wealth platforms. And if you have or had clients over the last couple years asking about Bitcoin and cryptocurrencies, our crypto block model might be a good solution for them, especially now that the price of Bitcoin kind of has stabilized a little bit here under 20,000. Okay, moving on to another one of our strategic allocations. This is the iSectors domestic equity allocation, and a change we made there just this last month. I want to point out, because again, we'll change this model, once or twice a year. Generally, is kind of the normal cadence of that. So as I mentioned at the beginning, this model does have a value tilt to about 75% dividend-paying ETFs, and so this quarter we went a little even farther with that tilt. We bumped it up to an 80-20 value versus growth tilt. We stay away from the core blend in the middle, and we stick with dividend/value ETFs on one side and then growth ETFs on the other side. So what we did, we sold 5% of a large cap growth ETF, and we bought another value ETF, which is the Pacer US Cash Cows 100 ETF at about a 5% position. COWZ, cows is the ticker there. It's an interesting fund that selects firms, underlying companies that have high free cash flow yield, and then it weights them by that free cash flow yield, and it will complement our quality focused dividend paying ETFs that I mentioned before pretty well, as they don't really have too much overlapping exposure. So we really like that ETF. But on the next slide, I'm going to speak a little bit more to why we decided to kind of go further with our dividend tilt for this quarter. As I said, value ETFs this year have outperformed growth, and we think that's going to continue. So this chart here looks at the growth to value ratio over the last 8 years, from 2014 to 2022. And that growth to value ratio is the Wilshire Large Cap Growth Index divided by the Wilshire Large Cap Value Index. So basically anything with a value over 1 will mean growth has been outperforming, and anything with a value under 1 will mean that value has been outperforming. So if we look at this chart over the last 8 years, for a very good portion of this period, from 2014 to 2020, value had been outperforming ever so slightly versus growth. But I think the main thing I want to point out, and that's where you'll see this yellow box here, the ratio stayed within a 0.2 band, from 0.8 to 1. And then even for a little while after, while growth started outperforming, it stayed within that 0.2 band of 1 to 1.2 up until about mid-2020. But then once we hit mid-2020, after the COVID pandemic started and the influx of cash came into the system, we saw that ratio explode up over that kind of 0.2 band, up over 1.2, and that's, you'll see where I have the red arrows on the right. Exploded. Growth outperformed value by a very wide margin in the second half of 2020, and basically all throughout 2021. You'll see the ratio even getting up to 1.4 in late 2021. And then, as I mentioned kind of at the start of the slide, the ratio started falling back in line in the second half of 21 and into in 2022, especially throughout most of this year, 2022, with the like I mentioned before, the stagflationary environment we've been in. Value and dividend ETFs started to outperform. But looking at this kind of longer term track record of the last 8 years, we think there's still some meat on the bone left for value to continue outperforming. And if that ratio stays kind of within this 0.2 band that it has historically over the last 8 years, we think the characteristics of value and dividend ETFs like we use, lower volatility and better downside protection that has been exhibited this year, we think it's going to be favorable for that. And that's why we decided to add a 5% allocation to our value tilt this year. And so after all that being said, and I mentioned we like value basically because the economic environment we have been in, and we think it's going to continue. I'm going to pass it to Vern now to kind of speak on that very environment so far this year, and also going forward. He'll present an example of a way that a way that an advisor could blend our models together kind of for this exact environment we're in. So with that, I'll pass it over to Vern to kind of speak on some of that.
Great, thanks, John. Yeah, we know this is a difficult environment to talk to your clients. We know it's a scary environment for investors, and we've certainly heard that from investors, and it's quite legitimate. We want to give you some ideas to help you talk to your clients, and obviously we want to keep them invested, and it's difficult. We understand their concerns. Inflation is higher than it's been in 40 years. Interest rate on the 10-year treasury bonds haven't been this high in more than 10 years. And actually on the 2-year treasury bond, they haven't been this high in 15 years. The S&P is on pace for its worst year since 2008. GDP is slowing, recession continues. The dollar's continuing to rise, causing other issues around the world. The dollar hasn't been this high against the yen in 38 years. It's difficult, and this past year is the worst year for a 60/40 stock bond portfolio in the last 100 years. So when clients are concerned, it's understandable. as John mentioned, our flagship models are indicating stagflation, and our best solution is diversification with special attention to inflation. We definitely think this is the inflation issue is going to continue to be a problem for our clients, especially for clients that are retired who have have their savings already saved, and inflation eats away its purchasing power. So um, our solution that we'd like to suggest, we iSectors, we have 22 models, but they're very they're really designed. We designed them to be able to use them and blend them together to meet particular client needs and objectives, risk attitudes, etc. So in this current environment, for clients that are concerned, and we might suggest an allocation of about 45% to our iSectors post-MPT growth allocation, a dynamic strategy that adjusts the allocation monthly, optimize risk-adjusted returns. And as John said, portfolio currently holds energy, gold, utilities, and healthcare. We're also would blend that with 15% allocation into each of iSectors inflation protection allocation, iSectors capital preservation allocation, iSectors domestic equity allocation that John discussed, and our iSectors tactical global balanced allocation. If you look on the bottom of the slide, this gives us about a one-third, one-third, one-third allocation. So you blend these models together, these iSectors allocation models together, will give you about a one-third, one-third, one-third allocation to stocks, bonds, and alternative investments. And if you look on the right side pie chart, you'll see that when it comes to this one-third in equities, and as John mentioned, this is our iSectors domestic equity, but also the healthcare that is coming from the post-MPT growth and the utilities. But it's a focus on the equity side of multinational companies, U.S. based equities with quality dividends. That's the overriding focus. We're staying away, you might notice, from emerging and developed internationals. We believe the banking problems and other issues and the dollar, et cetera, do not make it wise. And we're comfortable holding the multinational US based companies. On the fixed income side, where the portfolios would hold shorter term high quality bonds as well as short term tips. And on the alternative side, it's really a inflation hedge at this point, broadly diversified commodities, precious metals, energy, with smaller allocations to rare earth, pipelines, Bitcoin, REITs, etc. That allocation, among those five iSectors models would contain about 35 ETFs and hundreds of individual securities, so very well diversified. Don't worry about managing it. Our iSectors professionals are managing it. And in summary, right now, I guess we want clients to stay invested, but we don't feel the need to own emerging market or international. We'd rather own U.S. multinationals paying dividends. We want them protected from inflation and rising interest rates. And we want in addition, we want the clients to know that we're flexible. That's why our tactical global balance is we're looking at that right now. We want them to know we're flexible. We're okay with some dry powder in a sense, and clients will talk about this, but we really are concerned, and as most advisors know, the problem with timing the market, or going to cash at any point, is that investors won't get back in. And so we're okay with the dry powder as long as there's a strategic on-ramp, if you will, back into investments. And that's what the tactical global balance would give the investors, right? It's a methodology, it's mathematical. And when, as things begin to change, regardless of how investors might feel, this will ramp them back into investments, as the economic situation changes. So those are some suggestions. Obviously, the models can be allocated, or diversified among, blended, in any percentages that that the advisor feels is appropriate for their particular clients. We like this particular allocation and have suggested it, but you're also welcome to give us a call, and we'd be happy to discuss ways of blending models for your clients. Otherwise, I guess I'll turn it back to John.
Excellent. Thanks, Vern. Great. That's good stuff. So while I have this very important disclosure page up, I want to hit on what Vern said at the end there about different blends of these models, or any of our other models. Like Vern said, we have 22 of them in total. If you want to see any sort of custom blend for a certain client, or you're just curious about how some of the different models sort of interact with each other, we can run custom reports for anything you'd like to see. We can blend any of the models, and even the one that we just showed, we can. We don't publish the returns for that, but if you'd like to see them, certainly reach out to us, and we can put something together for you that you can at least get an idea of how a blended allocation like that would look versus some of our regular models, or versus any benchmarks, anything like that. So with that being said, and actually, so it works out well. The contact information here for myself and our Director of Business Development, Scott Jones, if you have questions about blends like that, or anything else for that matter, anything we didn't hit on in the webinar. I know we went kind of fast here just to kind of save some of you some time. Certainly reach out to either of us. We'll be happy to answer any questions you may have, or if you even want to schedule some time with Vern to really go deeper into any of the topics discussed today, we can do that. So with that, I'll open it up to questions, and if anyone has any questions, they can ask them now as well, if you haven't already, in the chat box in the lower right-hand part of your screen. Okay, so none so far. Doesn't look like any are trickling through. So with that, I'm going to end the presentation. A replay of this is available. We'll post it on our website as well. And I hope everyone watching has a great day. I hope anyone watching the replay also has a great day, has a good rest of the year. And we'll be sending out some more of these in the coming months, and for next quarter especially. So be on the lookout for that. Thank you everyone for attending. Have a great day.